Look at my post as well. Good morning. Are we live? We're live. Good morning. This is Vince Lanci with the Gold Fix as the Opportunistic Trader sponsors this for the public as well as for subscribers who have access to ask questions. Okay. Yesterday was a really, really good day. And let me just stop this part here. All right. Yesterday was a really good day. It was a good day not because it was profitable, which it was. It was a good day because, first of all, gold gave us a trade to do. And second of all, it was profitable. And third of all, it was a classic example of being undisciplined and making a little money. I'm not going to be going into too much on the macro markets today. I will put a post up on that later on, but it's all about QT as far as I'm concerned. Gold sold off because there's less interest. We're not talking fundamentals today. We're not talking story. We're talking. This is for active traders. This post, and it's so you can learn from my mistakes. It was a profitable trade yesterday, but my mistakes. All right. First, so surprise signal, profitable trade, and undisciplined risk management. Okay. All right. We're going to refer back to yesterday's post, which I changed the title on because we had an alert come in. So I'm going to click on that, and I want you to see that because at 10:59 a.m., or a little bit before that, actually, I think it was at 10:40 I did the trade. If you remember, if you listened yesterday and you read this post, the bottom of this post, which starts with yesterday, you'll know that we had the 60-minute volatility momentum signal on our radar, but I said it was not going to be a signal because one of the criteria was not met, and it was not met. And then I skipped the 4 hours saying, that's not going to happen, and then I went to the weekly. Well, what happened was, and this is yesterday, 10:59. This is a 5-minute chart. I put it up just so people could get an idea of how the move went. And that red line going across was roughly my initial stop, or my alert. My stop was a little higher. So let's just get this out of the way. A VBS signal, shockingly, I guess I'm writing like some mainstream media person now, was triggered on the 4 hour, which was not even our radar. So we got short at 12:17.30. That basis D's with a 12:23 stop. That's the trade on it. The target should be 12:07. I write it this way because we're not telling people what to do. Some people sadly have to be protected from themselves. Most people know that there's a difference between advice and what we do for ourselves. So I worded it that way, but we actually did trade yesterday. All right. So the target should be 12:07. That is, how I come up with those numbers is my business. OCO, that means one cancels the other. Close the trade in 12 hours regardless. Okay, so that means on the 4 hour chart, when I got a signal, I should sell it, which I did at 12:17 and change. And I should wait at least 12 hours before I close, as long as I'm not stopped out. Okay, so here's the trade in the chat room. And you see that these are the trades that are embedded with other traders. Larry had a killer day yesterday. I'm just happy that I had one trade to do. I could have done more, but God forbid if I do something to undo what we had in gold yesterday. All right, so you can see some of Larry's trades in there. All right, so at 10:40, roughly, we sold D's gold at 12:17.20. The X for me means stop. That's a stop loss at 12:23.50. I hated that level, but that is usually I have much tighter stops, but that is what the 4 hour stop gave me. Now, here's where technicals matter. I also wrote with concerns above 12:19, and that was because of the technicals that Michael Moore gives me. And this is actually a good example of interdisciplinary, two disciplines coming together and helping you make decisions. So there's the trade that went down, entering, and let me show you the closing trade just so we can get that out of the way, because there's more information there than just me saying I made money. Okay, so as the market sold off on the 4-hour signal, I trailed the stop to 12:15:10, and that was based on the system. That's a system-generated stop number using a 15-minute chart. Okay, and then there you see Larry starting off another positive trade that he had yesterday, and then I trailed the stop a little after that, about a half hour after that, to 12:13:20, and these are numbers that are generated by the VBS system, and they're to protect profits at this point. The interesting thing is that number, that 12:13 number, I'm surprised. We were trading about 12:13, 12:14 when the 12:15 stop went in, and it just did not go above it. And then we went to 12:13:20, and the market would not go above that. And then I remembered the whole teens thing, as taught by a trader that I've worked with in the past, that I've competed with in the past, and that I've learned from ongoing, that gold hates the teens. So it didn't get back above 12:13 during that next hour or so. But 15 minutes later, I did something very undisciplined. I covered the trade. So in an hour and a half, it may look like a great trade because I almost picked, I was near the bottom on the buys, but it was completely undisciplined. I should be holding that short today. Now, a trader like a Larry or me would say, well, now I can sell the rally if I still have a biased bearishness. And technical traders will do that. I see a bear flag forming now. I want to sell it. But this system, if I get in again today, will not be because of the system. It'll be because I see a bear flag, and I have a bias. I generally don't do that, get back in, because I'm not comfortable with formations that I'm not that familiar with. So I see a bear flag. Yes, I want to sell it, but where's my stop? Like, I'm not disciplined intuitively. So my discipline is external. So let's go back to the post. All right. So this is yesterday's post. All right, which said why we weren't going to have a signal. And let's go to today's post so we can talk about. Let's go past that. So this is what happened. So here's the 60-minute non-signal. This is today. So you've got to go back to before the red bars. Here, before the big down move. We had the big down move, and we did not have a signal because, if you remember, I think I drew a box on one of the other pictures. The 5-day. This is just one of the indicators I can share with you. The other ones I cannot, or I will not. The 5-day volatility has to be 50% or less than the 20-day volatility. That's historical volatility. And it has to precede a widening of the bars. And if you look at the blue line, it wasn't even below the red line. So I immediately dismissed it and said, we're not going to have a signal. We may have great risk reward, but we're probably going to get chopped up. What I missed was this. I dismissed this because the 4-hour wasn't as tight as I'd like it to be, but it was legitimately on my radar, and it gave a signal. It gave a signal at that hour at 5. I don't know what that 5 is there, but. Well, before we started, basically, it gave a signal in the morning to be short on new lows, and then I did not sell it on new lows because I was not watching the 4-hour bar. But when I said, you know what does this look like on the 4? I actually went to the weekly. If you remember, the weekly was what I was looking at. I went to the weekly and I was like, okay, it's nothing, all right. But then I went to the 4. I said, oh, look at this. This is classic, and the market was trading about 1217 and a half at the time. But the reason it was a signal is because, and I missed it a couple bars before, or actually that bar before, that's why I highlighted that bar. Historical vol on the 5-day is 0.77, and historical vol on the 20-day is 2.2, or 20 bar, I should say, is 2.24. That's the final criteria. And that says, get ready to get short in the next bar on new lows, and that's what I should have done. I should have been selling it, below 1221, which also is a number that technically goes back. The point is, I missed it, but I sold it anyway. And it gives you a natural stop of about 1223 and change in the next bar, or actually 1221 is the actual stop on this bar. So I sold it at 1217 and change with a 1223 and change stop. I gave myself more room because it seemed like a bigger move was going to happen. Uh, I should still be short right now. And if you look at the market, we've had 4, 8, 12, 16, 20 hours since that 4 hour drop where the market's gone sideways. Now, a technician's going to look at that and say it could be a bottom, it could be a pause before the sell off, it could be the beginning of a bear flag. I would look at it and say, look at those long wicks in the last 4 hours. I would be short with a stop above that as a technician, but I'm not. Uh, but I covered. The point is, I'm done. You should still be short here with a trailing stop had you used the system properly. So I was right for the wrong reason. And here's the point. I was looking at a 15-minute chart, and I was doing a little intuitive assessment. And when the market traded down to like 1211 and change, and then came back up, and I saw that we might have had a 15-minute lower low without a lower higher relative strength. We got that green bar, and I covered around that time. Actually, a little bit. I covered right before the big green bar at the bottom there. The takeaway is this, and this, regardless of whatever system you use, whatever discipline you use to trade, whether it be technical or fundamental, or whether it be a momentum based system like me, or a regression to the mean system, or an intuitive system, you must be disciplined in your use of it. Now, why was I stupid yesterday? Because if my system is entirely based on the asymmetry of risk reward, some people's edge or asymmetry or asymmetrical edge comes from one of several things. It could come from information flow, uh, uh, direct information flow. It could come from technical charts. It could come from volume. For me, it comes from momentum regressing to the mean. So I trade breakouts in the market because I know that volatility regresses to the mean. So when volatility is oversold, I buy volatility in the direction of the breakout. But my point that I'm actually trying to get at here is this: is is that your discipline needs to be adhered to, because if my edge or my asymmetrical aspect of my system, the volatility based system, is not, I don't, it's a 50-50 system. If I'm right more than 50% of the time, I'm a hero, because everything is risk one to make 1.5 to 2. So if I continue to do what I did yesterday, in the long run, I lose money because I risked one to make one, or I risked one to make less than one, actually. So this was a it looks very good intuitively. Oh, Vince, what, the bottom there? It's kind of cool. He can get back in and get short. No, I can't get back in. I can't get short on the system. I should have stayed short. I should have covered half the position if I wanted to and trailed my stop. But no, I just got out. And if you keep playing that game, where you're flipping coins 50-50, it's going to land heads or tails. But you're going to get paid off 50 cents when you win and lose $1 when you lose. You're going to be out of the game. For me, it's about capital management. I don't believe that I know which way the market's going. I do believe that if it does go, it's going to go fast. And that's where my asymmetry comes in. I go, all right, I'm going to risk one. I'm going to make two, or I'm going to be out. And I'm going to do it every time I get a signal. Yesterday was a bad example of that. I got out before I should have. The market should have dropped another $10. Then I really would have learned my lesson. But I did it for several reasons. And one was technical. The other was probably because I'm an impatient gold trader. Haven't had good opportunities on my system in a while, and I wanted to take profits before that ended. So the takeaway is this: if you have a system, whether it be intuitive or quantified or an algorithm, stick with the system, because you're not playing one hand of poker. you're playing. It's a numbers game. You have to, if you have a system, you have to be in it for 50 hands. So if you have $100,000 in capital at risk, you know, your system should be, well, my system, it's like a poker player system. I actually learned this from a championship poker player. He said, I risk no more than 1% of my capital per hand. Or I think he says 2%. And I go, why? He goes, I don't care how good my cards are. If I have four aces and we're playing Texas Hold'em and the other guy can have a possible royal flush, I will not go all in. And I'm like, assuming that he can't read the person is what his point was. I go, why? He goes, because I need to be in 50 hands for my type of poker playing to work. And so I won't risk more than 2% on any one hand. So don't risk more than 2% on any one trade was what I took away from that. And you'll be able to replicate the law of large numbers, whatever you want to call it. But the actual term I use is ergodics, because this system works in different markets. So ergodics means playing in different markets. But sorry to get too wonky with you here, but that's basically it. If you're technical, stick with it. If you're intuitive, stick with it. Just keep your capital risk more in the front of your mind when you're trading. If you're system based, stick with it. Don't violate your system, because if you keep risking one to make 50 cents, you're going to lose money, and you will have the psychology of regret working against you. Okay. Michael Moore's technical snapshot. This is last night. You can read the whole thing there, but he basically tries to encapsulate everything in one thing. Start with, this is on hold. We left a short-term bullish reversal. Okay. All right. Don't start with that. Okay. He's not really a big self-promoter, and by that I mean he doesn't brag a lot. But he just gently reminds you that he's right. He said in the post-market synopsis, which I don't generally share with you, that this went out fairly weak on the day. That was 2 days ago. We have seen 11 ticks or $11 of the weakness. There are areas of possible exhaustion for this move down from 1230.90 that come in at 1211.40 to 1209.70 and 12 even spot 80. Trade above 1219.40, 1220.30 is a sign of renewed strength. The maintained gap lower tomorrow will warn of trade for lower days. All right, to give you perspective on tomorrow versus today, this is the end of the day report yesterday. That's reminding us that the previous end of the day we went out weak. Look for the market lower. I strongly, this is something that people pay for. I don't share the whole report with you. I strongly, at the very least, give Michael a call and say thanks, and again, urge him to come up with a retail product. This is expensive stuff, and his oil stuff is great. I have a dog here, and it sees another dog. All right, so here's the global markets via the Opportunistic Traders overnight report. I use that chart because it's great. Black is for oil or coal. Red is for everyone else who's trading, and green is for Tom McEntee, who I suspect is Irish, not Scottish. Okay, there's an option class today. Little sardonic comment there. Don't be fooled by the coordinates in the world. Join Tom and me at 12 noon U.S. Eastern Time for the best options educational webinar out there. The worst spelling out there, but the best options webinar out there. Today we will be giving you how structured derivatives or structured products desks at banks create strategies for clients, whether they be low, medium, or high risk. It will be educational, it will be fun, and it will not be infotainment, which is something that I'm really actually, let me say this now so I don't have to take up time when we have it today. Opportunistic Trader offers, in my opinion, unparalleled education in portfolio risk management, real time, in analysis, both fundamental and technical, and now we're doing classroom situations. We do need your participation, because we want you to give us the stocks and ideas so we can give you something that's more uh, uh, sticky. Like if I want to talk about, oil, or I want to talk about natural gas and seasonal volatility arbitrage. You got to give us a stock. We need you to participate in that because you'll walk away learning a lot more. Tom and I have. I'm not speaking for Tom, but I'm speaking for Tom. Tom and I have a mission to educate without condescending or patronizing the listener. We also want those taking the time to listen. I can't even read my own handwriting. That's how bad it is. And we also want those taking the time to listen to not be bored. Thus, we hope to make it fun, but never at the expense of quality content. It's not going to be a show where we're hitting buzzers, but today you will learn and laugh and walk away knowing a lot more about options than you did yesterday. Uh, Even if you already know a lot about options, at least you'll get some impersonations out of it. Uh, we want you to listen to this because everything else that is out there isn't as good. And we only had one show, and it's going to get better and better as time goes on. Um, I'm really excited about this. And I'm a bad salesman. I can't sell. I'm a bad networker. I'm not a person who goes out there and self promotes. I build better mousetraps and say, WTF, why are you not using this, you idiots? And that's because I'm not a people person unless I really get into something. And the only thing I like more than trading is teaching. And you can shop around and ask some of the people that have worked for me and that I've taught. This will be fun, and Tom is a great partner to do this with. I'm belaboring the point. Just be there. Don't be stupid. All right. You tell me if I'm wrong. But today we'll talk about structures, how to use options to implement directional opinions. So today will be there are three ways you can use options. One is to make money. Two is to hedge or insure against losses. And the third way is that's directionally. And the third way is through trading volatility as an asset class itself, trading arbitrage for me. But today we're going to be focusing on directional, structured derivatives to implement ways to make money if you're bullish or bearish, low, medium, and high risk. It's 8:24. I got to hop. I appreciate. There we go. Larry starts at 8:30. I'll be on with him, and much less verbose, I'm sure. So come back at noon today. We'll be sending the links out for that. Look for it on Twitter. We'll throw it in a post and just listen in. It's going to be great. Talk to you later. Oh, and by the way, gold should continue going down. Below 1189, I think we're going to have new lows. That's an opinion. That's not a system comment, but the weekly volatility-based system says we're still in a range. What's the big deal? Everything else about it, to me, though, feels like QT is not ending, and stocks will continue. Stocks will go lower because they went higher, and gold will go lower as the dollar goes higher. And that's the way it is. Trade it from the short side, trade it from the long side, but trade it. Don't look at gold as an investment. All right. Have a great day.